I'm 92.90, 10 by 10. Yours.
Mine.
99 at the buck. Welcome to the Open Yield Markets Podcast with your host, Mark Hebert.
Mark Podcast, live from Studio A, which in the startup world is really Conference Room Z. We are really lucky today to have our guest, Chad Wildman, who is the Head of Quantitative Strategies at FMS Bonds, with us today. Chad is a former Morgan Stanley employee, which is where I met him. He was the co-head of electronic trading and quantitative strategies for their municipal business. He is a thrice degree holder from the University of California, Berkeley, a bachelor's, a master's, and a PhD, all in math or math-related fields. So I'm going to coin him today the Albert Einstein of the municipal bond world. We were fortunate last time to have Marty Manning and Matt Schrager, who I coined as the Lewis and Clark of the bond business. So today we have somebody, even more astute mathematically in Albert Einstein. So we're really pleased to have Chad on. Chad, if you wouldn't mind talking a little bit about how you went from Berkeley into municipal bonds with a math degree.
Yeah, sure, Mark. Great to be here today. Thanks for having me. Just before I jump into that, I think the Albert Einstein comparison is quite generous to me. The main similarity between the two of us is that he started out as a clerk and I started out as a bartender. But thank you all the same.
Hey, we're all about being generous here at startups, honestly.
Right. So yeah, I never really imagined that I would end up on Wall Street. I started out in undergrad and graduate school with an eye towards just, going the professor route, math research, all that. But when it came towards the end of my graduate studies, this was sort of in the wake still of the global financial crisis, and the academic job markets were very heavily impacted. It was incredibly difficult to get postdocs or professorships anywhere outside of kind of four-year liberal arts colleges. So I started to look around a little bit, and I used to get a bunch of junk mail from the UCLA Masters in Financial Engineering program. And one day I was living in San Diego at the time. I just drove up there and talked to him about it. And it seemed pretty cool. It was sort of a marriage of math, theoretical math, computer science, which I always sort of had a passion for, not as a sort of primary area of study, but just as a more of a hobby, and finance. And it really made a lot of sense for kind of what I like to do, practical applications of all the theory and what have you. So I ended up being accepted into the UC Berkeley one, and that program was, a short, intensive program that had a direct pipeline into lots of different places on Wall Street. And I bombed all my first fixed income interviews at Morgan Stanley, so they put me on the Muni desk, and here we are.
How do you think, in general, since you've been on Wall Street for, so long now, using a more academic background and this is kind of nice we're doing a podcast here because it's actually like you're doing a guest lecture. So it's kind of like exactly what you want to do your whole career. Here you are, and you're speaking to a student who needs a lot of tutelage. In myself, but how have you used this background of academia as it's gone on and building your models, your process? Like, how have you found, a lot of people who come out of college trying to get into Wall Street. You were a little bit more of a hidden gem, if you will, but how have you used that background in academia to your benefit, or has there been any little hurdles you've had to overcome?
Yeah, sure. I mean, it's almost sort of like a bootstrapping process where I can't honestly look you in the face and tell you that I use analysis of partial differential equations in my daily work because I don't. But that did help me very much with the subject matter in the quantitative master's program. They tend to take people who are strong in 2 out of the 3 areas of math, computer science, and finance. And I really knew nothing about finance at the time, but the math background helped. It helped me kind of not drown in that fire hose of a 1-year program. And then going forward, I think probably the most relevant aspect that I brought from graduate school is just kind of a discipline of thought. You spend a lot of time sitting there and thinking about a problem in a kind of somewhat structured way. And that definitely has served me well. I mean, a little math never goes astray, even in Munis, believe it or not. But it's kind of a combination of the two of the things I think that kind of helps me along.
Awesome. So let's get a little bit more about, what you do on a day-to-day basis now. You have developed and built a model to, trade municipal bonds profitably. Can you speak a little bit more about your model, your process, and a little bit about what metrics you look at, making sure your model is working correctly, or how you make tweaks, and I guess, just discuss a little bit more about your model and how you kind of make it more efficient as time goes.
Yeah, totally. What I mean, I'm basically a one person shop. When I got to a big bank and knew nothing, my inclination when presented with a problem or something being wrong is always to figure it out, all the way down to, debugging a fixed message in a log somewhere that I think a lot of people kind of would actively try to avoid doing. For better or for worse, I ended up in a spot where I understand pretty much the nuts and bolts of the whole operation, and that kind of put me in a unique position to come down here and try to do something myself from scratch. So, more or less, that's what I did. I did farm out the sort of lion's share of the actual quantitative work to Matthew Smith and his team at Spline Data. They've been a great partner and a huge help. I think I was client number one of theirs. I'm not certain, but a big part of what I do is that, and the rest of it is sort of built up around that. I focus a lot on system design. All of the connectivity to different trading platforms or data providers, what have you, is all custom in-house. So, I've spent a decent amount of time kind of developing those, making those more robust. And then to your point, that dovetails right into, once you prop up a house of cards and get it trading, how do you make it better? How do you measure what it's doing? And, I'll speak a little bit about that now. So, aside from sort of the obvious measures of profitability, the things that I like to get into are really more focused on what the components of profitability are. Things like carry, turnover, average position age, that kind of stuff. I mean, in this rate environment, carry is really, really, really bad. In fact, it's quite negative for pretty
Yep.
much most of the positions in my book. And that really forces you to do a different calculus than we had to do when we were just hanging around in ZERP. You're losing money every second that you hold most of the bonds. Um, and that just, I think, causes a rational algorithm to make decisions that might seem surprising, to your sort of traditional muni bond trader. So a lot of that type of stuff, aged inventory, carry, and turnover, I mean, they all really are the same thing. They all kind of are different sides of the same coin. The other thing that I like to do too is get really into the weeds on performance on RFQs. Um, you know, Various electronic platforms will have varying levels of electronic disclosure about where you ranked in the pile of people that are bidding on a particular bid wanted. Taking all that information, storing it, and processing it, and then acting on it in some type of, automated or semi-automated way is something I've spent a decent amount of time on. What happened on trades that you quoted but didn't buy, and all that kind of stuff. There's a lot of sort of corrections, I think, that can be applied to these types of models with those sorts of analyses running in real time in the background that I've had some success with.
And just for the users out there, as this podcast grows and evolves and our user base becomes hopefully deeper and not just finance gurus and junkies, but Aged inventory is basically the amount of days that Chad has a bond on his balance sheet without being able to move it. Carry is the amount of coupon he is getting off of his bonds. However, when you think traditionally about a bond's coupon, let's just say a bond yielding 4%, doesn't necessarily mean at the trading business level that you're getting 4%. There are costs to consider with funding that a piece of paper from the institution. So, what Chad is trying to say here is that if he holds bonds at 4% in this rate environment, he actually might be losing 50 basis points or 0.5% every X amount of time. So these are things he's talking about when he's factoring in his decisions about how to tweak his model. One thing I want to ask you also is, obviously I have a corporate credit background. Municipals, in my estimation, it's interesting that you are a quantitative guru in them, is in that the historical landscape of municipals is a little bit more old school, if you will. And the landscape of municipals, from my purview before I started here, is one where the asset class has probably stepped down in the liquidity profile from corporate credit. So I guess my question to you is, how has your model benefited from or been hindered by the differences and nuances of the municipal market? And do you see yourself as, one of few right now, as an advantage in this market where more and more entrants might be coming? Because in my estimation, the amount of quantitative strategies in munis is growing, but it's still nowhere near what it is in other asset classes.
Yeah, I would agree with that. We are getting more people in. Personally, I welcome them. I think that in the end state it is just better for everybody. The more efficient the market gets, I do think that is going to make me make less money and make the other major players make less money as well. But ultimately, it's good for the ultimate consumers that we're trying to protect here, the retail investors and even the institutional investors as well. The asset class, anyone that you ask about this is going to hit on a couple of sort of primary structural differences between us and whatever you consider to be the most similar nearest neighbor. The long only nature of the asset class, I think, is the one that ends up making the most difference. I mean, the tax exemption, sure, we'll probably get more into that later, but the long only aspect of it just really, really mutates it from from corporate credit and stops you from doing a ton of the things that you can do in corporate credit, especially as it dovetails into things like portfolio trading and ETF create redeems, simply because you just can't short a muni name at all. The CUSIP count, I think is something that people talk a lot about too. Like, sure, we have a ton of CUSIPs and there's some data quality problems that can arise from time to time. But I mean, at this point, it's 2025, like most personal computers don't really have that hard of a time dealing with that number of securities. And if they do, I mean, maybe you need to upgrade your motherboard or whatever. But
Right. There's enough cells in an Excel spreadsheet for all the Muni CUSIPs in the world at this
there
point.
there actually are, right? Believe it or
Right.
not. So I think that from as it pertains to the liquidity question, I mean, I think that liquidity is actually pretty good where we're at these days. You have quite a few algos running around. Most of them are from dealers that have, if not 100% automated, then close to that automated workflows, or at least like heavily integrated sort of seamlessly with the voice part of their business. I think if you're a buy side customer who has a decent kind of tech stack or implementation, you're kind of loving life right now.
Yep.
The biggest challenge for
Yep.
me is just trying to figure out how to exist in this ecosystem as a small player, right? Like we're a smaller shop here. I'm never going to carry anywhere even close to the balance sheet of my of Lewis and Clark over there and our former our former employees. And that to me has been the most interesting challenge, is figuring out how to scale a business down that I've only ever thought about how to scale up, right? Like you do all this stuff and you desperately want to just scale it up as much as you can. So there's definitely a lot of kind kind of unique things that come up from that perspective.
Do you find yourself in this whole scale up, scale down situation? Do you find yourself trying to find your own niche, or just trying to find Q-tips or a methodology that works for you? Like, uh, not to get tackled by these big players, or can you play in the same sandbox just in a different style, or do you find different arenas or different sandboxes where they may not be committing capital to?
Yeah, that's exactly the question. And so basically I'm trying to do all of that with sort of mixed amounts of success in each of those areas. Um, I've definitely noticed that it's easy to kind of get trampled a little bit in the sort of most liquid, heavily traded names, because it's not even just the other algo shops. In that case, it's just voice traders and names that have new issues, big new issues come to market a lot. You know, pricing can get a little wonky around the sale dates of those deals and stuff like that. I mean, that's all stuff that we have data for, that you can be perfectly prepared for. You know, a lot of what I try to do is just leverage, you know, relationships that I've built. I can do things really quickly, right? If there's a new protocol or a new platform, or I, you know, talk to a client that I've known for years and we come up with some idea, that's something that I can develop and deploy in, you know, a matter of days. That I think is sort of one of the more fun competitive advantages that I have at a smaller place is that. So definitely you know, I spend time looking at what I'm trading in terms of sectors and structures and what
Yeah.
have you, and I can see where I'm doing, you know, poorly in some and okay in others, and I also pay attention to that and use that information.
One thing that I've been very impressed by, just being in this seat now for X amount of months, is noticing how some of these quantitative players, yourself definitely included, I mean, you are the Albert Einstein after all, is the speed of which you can change. So, you know, if we implement a new protocol, or if you have a new idea or a tweak, you know, traditionally at some of these larger banks or institutions, this could take months to implement from start to finish. I've seen you and others being able to implement change within a week or less, at times, in something that's actually really business sensitive, where you think there's a real advantage, or something new to the market that we're rolling out or you're rolling out. So I think, to your point, your ability to actually act quickly, and maybe not, act quickly but not carry a big stick, is something that actually might benefit you rather, in kind of making money in short-term ranges anyways. Um, Moving on a little bit to market structure, and I think we kind of just alluded to this, but for the listeners and for myself, the Muni structure, uh, in its liquidity in general, you say liquidity is good. You can't short munis. So I guess the question I have, which is everybody has who's not a muni guy, how do you hedge your long positions? Not, I don't need specifics, but like, what is, because to me, I feel like everybody I speak to has a similar hedge, which means that these hedges to me feel really crowded. Is there a way to be more dynamic with hedging, and how do you hedge in general?
Yeah, it's the sort of classic difficulty in munis. You know, traditionally, people sort of put their finger in the air and sold some treasuries against their long muni positions and hope for the best. I mean,
Right.
you had sort of relative value traders. You would do that position by position, and you know they mostly did fine. But that strategy, I don't think really works well for this sort of high turnover, you know, automated algo style of market making book. Um, it's just the relationship between treasuries and munis is definitely there. I mean, nobody's going to
Yeah.
tell you they aren't correlated or whatever. I just find the relationship very unsatisfactory, and at the worst times it will just like completely reverse and go to like -1 correlation or whatever, right? So it you know, so what else is there, right? There is, you know, sort of a thinly traded derivative market in munis. We have products called MMD rate locks, which effectively allow you to buy or sell the absolute level of the municipal, you know, benchmark yield index for better or for worse. those are fine. Like there's some depth there. There's a few dealers that participate in that market, but it's really expensive. And so in zero interest rate world, that was like decent hedge, no big deal. You could spend 5 or 6 basis points a month on hedge and not care too much. But with the carry what it is now, like you're just dead if you try to do that. So
Yeah.
the other things that I've heard of people doing are running correlations and doing long short munis and corporates. I think that's a really cool idea too, especially if you are planning on trading the corporates themselves in some type of kind of integrated algorithmic approach to both asset classes at the same time. I think that sounds the most exciting. But that's not necessarily available depending on the size of the shop.
Sounds about right. I think the corporate beauty thing is pretty interesting, and you have to probably do it either, like I said, get really deep in the weeds on the credit, or do it almost on a portfolio standpoint on the corporate side, and just say, okay,
Yeah, it's
I'm gonna
super
short a basket
interesting
of
too.
triple Bs against or a high triple Bs against this, low single A portfolio munis or whatever, something of that nature.
Super interesting to me. The Muni corporate credit basis, that makes almost no sense when you say it like that. But that's the thing to me that I don't really have a sort of fundamental economic understanding of. What's going to make that basis blow out or contract for a prolonged period of time. I don't really know, but probably.
It's funny, when I was probably 6, 7 years in my career, they had me trading universities. And it was one of these things where the corporate desk wanted the universities and the muni desk wanted the universities, and they were all super high quality. And I was trading them, and I never forget. I went into an office one time. I looked at my boss. He's like, "Well, what do you think about Harvard?" I'm like, "Well, what does everybody think about Harvard?" Like, I'm not going to short a Harvard bond. I don't care what the spread is. It's one of these things where, and then I actually said, I'm like, "There's no edge here." Like all the universities that I traded at the time were, I believe, double A rated or higher. And I was just like, "Let's give them the munis. We can focus on other things." But I was like, "Yeah, what do you think about Harvard? What
Yeah.
do you think about Yale? You want to short Yale? You want to put a Harvard Yale trade on? Not me. I'll be long both." Um, the one thing I've also been learning in this muni market that's really eye-opening is the bid wanted process is extremely different from corporate credit. It's extremely different from equities, rates, FX, you name it. It's a lot of what you just talked about with the inability to short munis and liquidity and the amount of CUSIPs. There's a myriad of reasons why this process is opaque and different. One thing we're rolling out here at Open Yield is what we're calling our RFO, and that is taking advantage of these new algorithmic quantitative strategies who will supply levels on the bid side at all times to populate bids, automatically by a trigger or a ping. And I think this is something, it's a novel idea that we're coming out with. But what I'm learning is the bid wanted process is something that needs a revolutionary change. And we're obviously trying to help with it. And I think you're on board with that. But I was curious if you could just speak a little bit about why the bid wanted process is where it is, and what other things have happened in the last 10 years that maybe haven't worked, and what do you think the solution is?
Yeah, I would be more than happy to, because our bid wanted process drives me nuts on a routine basis. It's quite silly. And from a technical standpoint, there's absolutely nothing wrong with it. We have all of the fixed messaging that you could possibly need, all the different platforms, all the different phases of workflow and what have you. That stuff is all there. What makes our bid wanted process silly is that the collection time is in the span of hours, and the firm time is in the span of hours too. It's crazy. And so I will be sympathetic to customers who have lists where the average lot size is, 1 million plus or 2 million, 5 million, or even higher bonds. I get it, right? You want voice desks to see those. You want sales forces looking at them and talking to everybody and soliciting the best order, whether it's stock
Yeah.
or third party, and putting the best foot forward and getting the best execution. That's fine. I consider that sort of like a semi-electronification of what is and probably will be for some amount of time anyway of voice workflow. In the odd space, though, however, it's kind of silly. And the reason that it's like that is because you just have such a varying level of kind of quantitative sophistication across the client base, right?
Yep.
So people aren't doing it to be annoying. They're not doing it because they think that they're getting one over on the dealer community or something like that. They're doing that because their workflows are still not kind of caught up to where some of the rest of the market is. You have plenty of buy side customers who will put out thousands of items daily on BWIX and process the results programmatically and quickly. I just think that for whatever reason, there's nothing really stopping them from having longer collection periods and long firm times. So why would they? I mean, it's kind of we need some sort of impetus to get people to kind of trim that down to a more reasonable length of time. And if you don't have unlimited balance sheet, that presents a challenge, right? You're firm on like, say that your target win rate on something is like 10% or 20% or whatever.
Yep.
That means that you're technically on the hook for 5 times your risk limit in bonds for half the day. It's a very unsettling place to be. That
Yeah.
being said, um, I think that the protocol you guys rolled out is very exciting. We're as you know, we're testing it in the test environment even as we speak. And
Yep.
I think that that's the sort of thing, hopefully, that will make people realize that it doesn't have to be the way that it is anymore, and check it out, see what kind of liquidity you can get just from the algorithms. And I think below a certain size threshold, people will kind of come to the realization that it is just better to get this stuff done faster and
Yeah.
in some type of programmatic fashion than it is to have it hanging out there all day.
Yeah, because if you have a bid wanted list on, let's just say 500 items at 20K an item, and it takes the average list right now hours to trade, you're leaving yourself a lot of market risk as well, time risk and whatnot. And I
Yeah.
think, the corporate credit market, start trading on auto execute on really small sizes outside of a benchmark, right? So if you're a trader or a PM and you submit a list and it says, hey, this is benchmark plus or minus 2 basis points, execute it. If it's outside of X bounds, don't execute it. There's no reason why, that shouldn't happen on these kind of RFOs where if you ping a algo provider and there's some sort of benchmark and it's in your range, you can hit it and move on and get seamless, time sensitive execution. So I think it's highly compelling. The last thing I'll ask about market structure before we go into a few quick hits, and this is one of these questions where it's almost like the fun question, if you will, but is there some sort of an aha thing in munis or some sort of a market structure thing that you think is coming? And it could be, regulation, it could be something from a technology standpoint, but is there something in munis that you think has a chance to make a big change in the market structure going forward? Or you think, munis as has been will be?
So I kind of see us as on this slow grind towards a better place.
Yep.
I think that from a political landscape, geopolitical landscape, there's plenty of potential landmines along the way. We may get into talk about how the administration plans on funding this tax package that they're trying to get through the muni tax exemption and all that. I think that generally speaking, we're on the right track. You have more people entering the market that are doing things in an automated fashion and providing liquidity, automatically. Nobody on the buy side is asleep at the wheel, I don't think, in terms of getting themselves up to speed and bringing more automation to their Albot business. You've got more and more money coming into SMAs at an
Yep.
alarming rate. I mean, a pleasantly alarming rate, at least I think.
Yep.
And so I kind of maybe I just don't have the vision, but I'm not seeing like some click that's going to happen because of the structural differences between us and the other markets. I think that we're just going to continue to sort of improve incrementally until we get to a place where really it's just sort of this moving line of par amount, above which things are sort of still handled by voice and below which things are pretty much mostly automated on both sides. And then that line may move over time.
Yep. I think that's probably spot on to how I assess things. Okay, just some quick hits here. Basic thoughts. This is not municipal related. This is more for market banter and fun. Tariffs and interest rates. What do you think about them next 12 to 18 months, or 6 to 12 months, I should say.
Yeah. No, I know this one. Inflationary. Wait, deflationary. Wait, no, I don't know. Uh, certainly producing plenty of volatility, you know. I've never been much of an economist at heart. I kind of spend a lot of time staring at the economic data as it comes out, and then looking at the rates charts and scratching my head and asking somebody else why that produced that particular result. But jokes aside, you know, the there obviously a lot of news came out over the weekend and the first couple of days of this week about tariffs. What is an all-out trade war going to do, both in terms of the equity markets and the rate markets? It doesn't feel great right now, at least not from my seat. I don't know, what are your thoughts?
Yeah, I mean, I'm of the same opinion. I think that there's probably posturing and politicking going on here, but if you're talking about establishing long-term tariffs and escalating, taking a world leader like ourselves, we're almost, it can't be quid pro quo tariffs with everybody. You can't, as a world power, you almost have to be the benefiter of others in some degree. But my real stance is probably a little bit more politicking and posturing, and that there's a happy medium where there'll be some tariffs and hopefully less reciprocation. But I think it's just a very similar playbook to the first 6 months of his first term, and I think that the only difference is the other nations probably aren't as willing to accept it as they were last time, or at least not willing to accept the posturing. So we'll see. But I do think that usually when a executive branch has a mission about interest rates, it usually happens. And so far, since the office has come in, they said, hey, we don't mind extending the curve and getting lower interest in the front end. And if you've seen, we've had a steeper curve so far. And so it's early, but I think a lot of this is posturing, and we'll see how it plays out. So you moved to Florida in COVID, plus minus? How's life in Florida versus the Northeast?
Yeah, that's
And
kind of
versus Napa Valley, I should say.
right. I don't want to be the guy that moves down to Florida and then rubs it in the face of all the people still in New York, but I'm definitely that guy. uh best trade I've made yet, we
Was this
we
trade part of the model, or is this a fundamental
yeah.
trade?
I went into Chat GPT and I asked it how to build a Muni model, and the first thing it said was move to
Move to
Florida.
Florida.
Right.
I should actually make sure Spline has that in their model.
I know. No, we were late down here. So unfortunately did not get to participate in the sort of pre-Exodus real estate market. Bought at the top, but other than that, we came down in late 2023, and it's a different place and also a different job. So kind of the combination of the two of those things are a much different lifestyle, but I am very, very happy with it. It lets me be much more of a family man than I think I otherwise would have, and so everybody's happy all around on that front.
That's fantastic. I hear a lot about that with people who move from New York City. You can actually make it to games, you can make it to the events and stuff. You're
Yeah.
not showing up at halftime.
It's funny, right? Like you hear the same thing from people who work in financial markets, but on the West Coast of the United States, because they're working New York hours, but in California. Here it's just because we stop working at 3 o'clock.
And then, I hear that you're a big viticulture enthusiast, a wine guy. What's your favorite variety of wine? I know you're from the Napa region, but what's your favorite variety of wine, or what do you enjoy on a Friday evening?
Yeah. So I grew up on Mount Veeder. My parents actually still live up there, way up at 1,700 feet, which for the Bay Area is pretty high. On a
Yeah.
clear day, you can see all the way to the San Francisco Bay from up there.
Oh, wow.
There is there's very good Cabernet Sauvignon that grows on that mountain that I think has a distinctive taste. I've always been partial to it, having grown up there. So my favorite wine clubs are the ones up on that mountain where I grew up on, and pretty much exclusively drink that with a few notable exceptions.
Any winemakers you want to point to?
Yeah,
Of those
I mean,
cabs.
my absolute favorite of all time is a winery called Miacamas, which is about just a mile up the road from my parents' house. They've got like 475 acres or so at the absolute top of Mount Veeder, and for my money, that's the best Cabernet there is.
There you go. My Camus. Is that how you pronounce it?
Yeah, some people say
I think
Miacamas.
yeah, Mike.
I'm pretty sure they're wrong, but yeah, Miacamas.
And then my final question is, I did a little bit of research on Mount Veeder. So, trivia question,
Oh,
who is Mount Veeder named after?
oof. I am sad to admit you've got me cold on that one.
Well, it's not because he's not a mathematician. That's why. So, Reverend Peter Veeder is who Mount Veeder is established after. He was a Presbyterian priest who started winemaking in 1850 as a priest.
Wow.
And
Wow.
so they named the town after him, or the area, I should say, a few years later. So just a little, that's called knowing your guest, doing all the homework before you get on the air. But, so Peter Veeder.
Good to know.
Well, Chad, I really appreciate you taking time out of your afternoon, even though it is after 3 o'clock. So I guess you are done for the day, as you just mentioned. But we generally and greatly appreciate all your time and insight and thoughts on the market and market structure. And thanks so much for your time.
Thanks so much for having me. It was a pleasure.
All right. Take care. Thank you.